Hey guys, welcome to Pounds Invested. I'm your host, Stephen Georgiev. So, in today's video, we're going to talk about something which has been getting a lot of attention over the past couple of weeks, namely stock splits. So, to find out what they are, why they're suddenly popular, and whether or not you should invest before or just after a stock split, stick around. And if you find content like this useful, be sure to smash the like button and also subscribe to my channel for more videos like this. Now, let's talk about stock splits. So, the fundamental purpose of stock splits is to increase the number of shares to make each individual share cheaper to buy or to otherwise increase liquidity in the market so that more buyers and sellers can transact more easily at cheaper prices. So, let's illustrate by way of an example. Let's say company A is worth £1 million and it has 1,000 shares. That means that each share is worth £1,000. Now, as I'm sure you're well aware, £1,000 for a single share is incredibly expensive, and there are very few companies who get to anything like that sort of price level. Now, the second thing to bear in mind is that by only having 1,000 shares in issue, what you're doing is you're creating a very limited marketplace for buyers and sellers. So by carrying out a stock split, you're increasing liquidity so that more buyers and sellers can transact in your company shares. So now, after carrying out the stock split, rather than having 1,000 shares at £1,000 each, you now have 10,000 shares at £100 each. So what does that mean in practice? Well, you now have more shares at a lower price, which means it's more attractive for individual and other smaller investors to invest in your company, and so you're more likely to be able to grow faster because more people have access to your shares. So, does that mean that every company should carry out a stock split and have its share price as low as possible? Well, maybe not, no. So, with the current popularity of apps and other trading services which allow you to buy fractional shares, you can start investing from just £1 and you can buy a fraction of a single share regardless of its level of price. And so I suppose functionally, you could well argue that stock splits are kind of an irrelevance now that things like this exist. And just to illustrate the point, we can see on this chart right here that stock splits were particularly prevalent in the 1990s, but since about the year 2000, the number of stock splits per year has gradually trailed off to the point where now there are only a handful or so every year. Fundamentally, it's worth remembering that there is no change in the intrinsic value of a company just because it carries out a stock split. It's literally the equivalent of me giving you a £10 note and you giving me 10 £1 coins in return. All it's doing is just breaking apart what's already there into smaller pieces so that more people can get a slice of the pie. So, now that we've covered what a stock split is, why do companies do it? Well, the main reason why companies might carry out a stock split is to tap into investor psychology. How does this work? Well, if you have a company which has a share price of £100 and then you carry out a stock split so its share price becomes £10, psychologically, investors feel like they're getting a bargain because it used to trade at £100 per share. It now trades at £10 per share, and so psychologically, there's a belief that it may well someday go back to trading at £100 per share. And this price increase would have to happen purely out of an increase in company value. So if you had a company which had a share price of £100 per share, psychologically, it's much easier after a stock split where the share price is now £10 to gain 10% by going to £11 rather than having to go from £100 to £110 for the same 10% increase in value. So psychologically, by investing in a stock split, a lot of investors have the feeling that they're getting a bargain, when in reality they may well not be, because let's remember, there is no change in the intrinsic value of a company just because you carry out a stock split. Let's look at a practical example, shall we? So, the Tesla share price is currently around about $1,500. To make 10%, that would have to increase by $150. But with the 3-to-1 stock split, so the stock price is now $500, in order to make your 10% return, it only needs to increase by $50. So it's much easier to go from $500 to $550 to make 10% than it is, psychologically at least, to go from $1,500 to $1,650 to make that same 10% return. So let's look at some more theoretical examples, shall we? So if Google had a 5-to-1 stock split, their share price would go from $1,500 down to $300. Just imagine what that would do for liquidity and how many more individual investors would be able to buy in to Google at the lower share price. A similar thing with Amazon. If they were to carry out a 5-to-1 stock split, that would bring their share price down from $3,300 down to $660. Again, with the amount of money Amazon produces, imagine the investor euphoria when you find that you can buy a piece of Amazon, a whole share, for $660. So, now that we know how stock splits work, should you invest in a company which is just about to, or has recently carried out, a stock split? Well, here's a table comparing post-stock split performance of companies to the wider S&P 500 market. And I'd like to draw your attention to three things. First, let's look at the 1-month performance. As we can see from these cells of the table, a company which a month ago carried out a stock split typically has a lower return and is on average slightly less likely to trade on a positive basis than the wider S&P 500 market. So, over a 1-month period, we can conclude that stock splits have on average a negative return when compared to the market. Now, let's look at a wider time period, shall we? 3 to 6 months. Over 3 to 6 months, we can see that on average, the return is slightly above the market, 1.5% versus 1.44%. But let's bear in mind that although the average return is ever so slightly above the market, you have a slightly smaller chance of making a positive trade. What does that mean? Well, just because a return is above the market doesn't mean that it's above where the company would otherwise have traded if it hadn't carried out the stock split. Now, one last thing. If we focus on the bottom row of this table, we can see over time that the number of companies after having carried out a stock split, which then go on to beat the market in any particular time period, is around about 50%. So what does that mean? Well, it means that if you invest in every single stock split that's going on, you'll be above the market half the time and you'll be below the market half the time. Now you can judge for yourself whether or not that's a risk worth taking. Personally, I'm not entirely convinced it is. So with that said guys, remember the fundamental behind a stock split is all you're doing is you're increasing liquidity for buyers and sellers, and there's fundamentally no change to the intrinsic value of the company which has carried out the stock split. Well, that's it for today's video on stock splits, guys. If you found this content useful, be sure to smash the like button, and for more content like this, be sure to subscribe to my channel. In my next video, we'll be looking at the difference between two opposing market psychologies, those of investing and trading. What's the difference? Are they just synonyms? Is investing the same as trading? And if not, how do they differ? And which approach is best for you for the long term? To find out that and very much more, I'll see you in my next video in a few days' time.